Treasury bond bailout or backfire? And should we all just buy gold instead? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. It's been another crazy week in the bond market. So this past Wednesday, August 19th, 2026, the Treasury announced increased sizes of nominal long-end liquidity support buybacks beginning September 9th. The current maximum size of $2 billion per operation will be at least $4 billion per operation. These planned operations dominated the markets for the rest of the week, initially pushing long-term Treasury prices up, meaning yields went down, as the Treasury likely had hoped for. Unfortunately, this did not last very long, and most media headlines were quick to deem the government's buybacks a failure before they had even started. From CNBC just a day later, Treasury yields rebound, wiping out the decline following Treasury Secretary Bessent's intervention. We've had some lively member discussions this past week in our VIP investment club as well, and lots of questions from our wider Diamond NestEgg community, such as, might Treasury yields continue to rise towards 6%? Or, as this Wall Street Journal article touches upon, would we even take this as a sign to flee the dollar for gold, Bitcoin, and other alternative assets? What the market calls the debasement trade. So, with that in mind, here are the three topics I'll be covering in today's discussion. 1. What does the Treasury want to achieve with its intervention? And how did markets react? Plus, should we prepare for higher yields or even a collapse of the dollar? 2. Where did Treasury yields close out the week? And what might the guaranteed lifetime income numbers look like for fixed indexed annuities, FIAs, with an income rider? This section will be of particular interest to those of you in our community who want to lock in the current rates for the medium and long term, and the FIA with an income rider specifically for those of you who can wait a few years to take your income, but still want to squeeze as much juice as possible out of today's rates before they may potentially come down. And 3, for those of you who still want safety but are less focused on guaranteed lifetime income, how much more can you earn with multi-year guaranteed annuities, MYGAs, from top-rated insurance companies? Annuities generally track interest rates, which means that annuity rates are also at very good levels right now. The highest rate we have in this section of today's discussion still stands at 5.65% on a $100,000 7-year MYGA from an A-plus insurance carrier, but some 3 to 7 year MYGAs remain above 5% as well, even with some of the highest rated insurance companies. Let's dive in now, folks. What does the Treasury want to achieve with its intervention? And how did markets react? Plus, should we prepare for higher yields or even a collapse of the dollar? As we've discussed frequently on this channel, long-term Treasury yields have been going up since the beginning of the year and are now at levels that are significantly higher than the average over the past 20 years. While this is attractive for savers and investors, it is much less attractive for a government who has to pay the coupons, the interest payments to finance our ever-growing national debt. So, what Treasury Secretary Bessent wanted to signal to the market with the larger buyback operations was his willingness to intervene and bring long-term yields down by buying back some long-term treasuries. In short, the mechanism here is that the extra demand for long-term treasuries should drive up prices, which again means that yields should correspondingly fall. Remember, it's always price up, yield down in bond land. The end result in an ideal world is that this should make borrowing at least a little bit cheaper again for the government. As we already touched upon earlier, this worked initially. We can see from this chart for the benchmark 10-year Treasury, yields dropped sharply after the announcement, but the effect was short-lived. And by the close of the week, at the time of this taping, on August 21st, 2026, yields were pretty much back up again where they had been before. We'll speak more about where Treasury yields ended the week in the next section of today's discussion. In addition, the value of the dollar against a group of 6 major foreign currencies, including the euro and the yen, as measured by the US dollar index, also fell sharply after the Treasury announcement. But the dollar didn't recover and ended the week down by 0.8%. So, that's the story behind the ongoing media headlines about the intervention not working and a potential debasement trade starting. Treasury yields dropped initially, but recovered quickly to their previous levels, and the dollar now stands lower than at the beginning of the week, while alternative assets are up. For example, gold is up 5.02% for the week, and Bitcoin is up by even 21.82%. Do note, though, that the steep increase in Bitcoin's price was also driven by some favorable signals from the administration and the Securities and Exchange Commission. So, what do we make of all this? Now, we don't have a crystal ball and no one can predict the future, but personally, we think there are 3 takeaways from this week. 1. This week proves again that long-term rates have their own lives and are not easily controlled by the Treasury or the Fed. While they can move the needle on short-term rates, this is just the starting point, because medium and long-term rates are also influenced by additional factors, such as the supply and demand for long-term bonds, the expected returns on competing investments, such as stocks, and the market's general outlook for inflation and the economy. Now, those who know me well would not say that I'm generally a glass is half full kind of person. I guess it's the financial advisor part of me that always has one eye out for the worst case scenario. But sometimes it makes sense to take a step back and take everything in, because buried beneath what often feels like ongoing doom and gloom headlines for our country these days are also quite a few signs of silver linings. Bloomberg announced on Friday that U.S. business activity expands at the fastest pace since 2022. The article goes on to say that U.S. business activity grew at its fastest pace in more than 4 years, as stronger demand and a rosier outlook fueled a wave of hiring. And the S&P Global's Purchasing Managers Index was the highest since 2022 as well. This is good news, and together with an S&P 500 that closed the week at 7,674, still up 12.11% for the year, and close enough to its all-time high from a few weeks ago, both may have contributed strongly to long-term Treasury yields going up again for the week. Now, as we discussed before, the Treasury will only actually start its additional repurchases in September, but in our mind, it's very likely that the impact of any intervention will remain limited if the economy keeps growing and or the equity market sends fundamentally different signals. 2. Inflation expectations remain above the Fed's target rate of 2%. For example, the expected average inflation for the next 10 years is currently 2.34%, as measured by the break-even inflation rate on 10-year tips. Now, this might not be too bad in the grand scheme of things, and it could be much worse in our mind. But it has gone up by 9 basis points since last week, when it was only 2.25%, which is a substantial move in this case. We suspect that after this week, the market's fears have been rekindled that the government might be tempted to rely more on higher inflation than on hard decisions about savings and taxes to get the deficit under control. We'll need to see, but that's definitely something we'll keep watching out for. That said, the real yield on the 30-year TIPS reopening auction this past week still came in at 2.973%, the highest in almost 25 years. So congratulations to all of you who are buyers in this auction. So, with growth accelerating again, and equity markets still near record highs, plus, and maybe even more importantly, concerns about inflation growing again, and the conflict with Iran showing no signs of coming to an end anytime soon, the CME Fed Watch tool now puts a probability of 40.1% on a rate hike by the Fed in September. Now, this wouldn't necessarily impact long-term yields directly, as we just discussed, but it wouldn't help lower them either. As we've said often on this channel, Marcus and I believe that what we're currently seeing may just be a return to normalcy. We doubt that we'll go back to the very low yields that we saw in the long aftermath of the global financial crisis, as the economy dug itself out of the hole over many long and slow years. Could we see long-term yields for the 20 and 30-year treasuries staying in the 5% range or even going up a bit higher? Yes, we could, unless fears of a recession or total market meltdown rear their ugly head again. But let me repeat again, long-term rates are still currently at or near their highest levels in over 20 years. And takeaway number 3 for this week. We remain confident in the role of the dollar as the world's most important currency. As you can see in this chart from the IMF, the International Monetary Fund, the dollar's importance as a reserve currency, the dark blue bar at the bottom, does not appear to be under threat, and there's no real challenger in sight. So, in our minds, while gold and cryptocurrencies can play a role as alternative investments in a diversified portfolio, we will stick with our general recommendation of treasuries, annuities, and similarly safe investments for the base part of a portfolio. Now, there is another sticking point that media headlines appear to be beating to the drums about: our growing deficit. Is this a problem? Yes. If the government really wanted to fix it, could they? Also yes. From where we sit, there are at least 3 different ways that this could play out, but we'll save that for one of the upcoming weekly updates. That will be a great video, so stay tuned. VIP Investment Club members will be diving deeper into everything we've discussed here on this month's Member Live, happening today, Sunday, August 23rd at 5 p.m. Eastern Time, 2 p.m. Pacific Time. And if you're watching this video within the first few hours of its release, we'd love for you to come and join us on our VIP Member Live as well, or to watch the replay in our VIP Member Zone. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've linked all the details below for your convenience. Other topics I'll be covering today on our VIP Member Live include the growth in AI debt, CUSCs, and another potential wild week for bond markets if the U.S. actually goes through with economic sanctions on Iran. Plus, how are our members thinking about inflation and how best to protect your life savings? As we always say, everyone's financial journey is different, and what we've shared with you today is through our own lens. Your world and economic views may vary. Plus, we may see some potential spikes and troughs along the way. Some may be short-lived, others less so. We've all been witness to how fickle markets can be and how quickly sentiment can reverse course, which is a great segue into the next part of today's discussion so that you can decide for yourself if this might be a good moment for you to lock in some attractive coupons and a potential guaranteed income for life. Where did Treasury yields close out the week? And what might the guaranteed lifetime income numbers look like for fixed indexed annuities, FIAs, with an income rider? So, for those of you who are laddering treasuries in the base part of your portfolio for a safe, stable, and predictable income stream that hopefully lasts a lifetime, let's take a look at treasury yields from this past Friday across all the maturities that the Treasury issues at auction. This row shows where they closed out the week on August 21st, 2026. This row here shows the increase or decrease in rates over the past week. And this row here shows the increase or decrease in rates since January 2nd, 2026. Increases in rates are shown in green and decreases in rates are shown in red. The 1.5 month and 2 month were down, and the 6 month and 20 year were unchanged. But all the other maturities were up, with the biggest increases to be seen in the 1 year through to the 7 year. All of which kept their 4 handles, with the 10-year at 4.74%. The 20-year and the 30-year remained firmly above 5%, pretty much unchanged from Friday to Friday, despite some volatility during the course of the week. All maturities are above where they were at the beginning of the year. As you can see, the dip in the middle maturities that we saw for much of last year and even in early 2026 is gone. In other words, we now have a normal yield curve where longer maturities pay more than shorter ones, as they should. Keep in mind that these Treasury numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ from what's shown here, depending on when you're transacting. Now, we don't have a time machine, unfortunately, and rates could go up or down in the future. But as we've said before, personally, we feel that these yields at or near 20-year highs may present a golden moment to build out your Treasury ladder and or lock in a guaranteed lifelong income with annuities if you're close to or already in retirement. And for those of you who are looking for a truly guaranteed lifelong income stream, like the vast majority of Diamond NestEgg members, super savers, and course folks who've reached out to us personally via email recently, remember that the only way to really do this is via specific types of annuities, such as a fixed indexed annuity, or FIA, with an income rider, a single premium immediate annuity, or SPIA, and or a qualified longevity annuity contract, or QLAC. Annuities, like many other fixed income investments, are based on Treasury yields, so their payout ratios are currently at 20-year highs as well. Let's have a quick look at what the rates might look like for a 65 and 66-year-old couple in California who invest $100,000 into a FIA with an income rider from an A++ rated insurance company and waited 7 years before they took their first guaranteed annuity paycheck. This couple might earn a lifelong guaranteed income of $12,796 per year from year 8, as long as one of them is alive. And if they waited 10 years before they took their first guaranteed annuity paycheck, they might even have earned a lifelong guaranteed income of $15,200 per year from year 11. And if you're further from retirement but like the current rates and market levels and want to lock in a future guaranteed lifelong income stream at some point further down the line, the same mechanism from FIAs with an income rider can help you as well. For example, for a $100,000 investment, a slightly younger single male or female of 60 living in Florida who perhaps is willing to take on a bit more risk with an A+ rated insurance company and let his or her money grow for 12 years with roll-ups might start receiving a guaranteed lifelong income of up to $21,012 per year from age 72. Personally, we feel that these are quite attractive guaranteed payouts on a one-off investment of $100,000 and may or may not be easy to replicate if the investors in our example were to wait to lock in their lifelong guaranteed income. Keep in mind that all the annuity rates and numbers mentioned in this video are for illustrative purposes only. Your personal rates and conditions are not locked in until you sign your annuity contract. And as always, email us at jennifer@diamondnestegg.com if you'd like to see what your personal rates and conditions might look like whenever you might be watching this video. There's no one-size-fits-all cookie-cutter solution. Any annuity you buy should be customized specifically for you. And let's move on now to the next part of today's discussion for those of you who may not necessarily be looking for guaranteed income for life and who don't mind giving up on some liquidity for potentially higher yields than what treasuries can offer that are still safe. How much more can you earn with multi-year guaranteed annuities, MYGAs, from top-rated insurance companies? Here are some illustrative sample MYGA rates from an A++ versus an A+ insurance company that we work with. Remember that A++ is the best credit rating that an insurance company can get from AM Best, meaning the MYGAs from the A++ insurance company that we're about to share with you are the lowest risk, making them the most comparable to treasuries in terms of risk-return profile. An A+ is the second best credit rating that an insurance company can get from AM Best, so still very safe in the overall big picture, generally speaking, but maybe not as safe as treasuries, especially if you were to go above the protection limits of your state guarantee association. In this top section, we'll go through what the numbers look like for an A++ insurance company. And in this bottom section, we'll go through what the numbers look like for an A+ insurance company. Here you have the investment amount required. And here you have the guaranteed MYGA term from 2-year all the way up to 7-year for the A++ insurance company. And for a 3-year MYGA, 5-year MYGA, and 7-year MYGA for the A+ insurance company. For this A++ insurance company, rates have not moved since last week. For a 5-year MYGA, you might be able to get 5.1% for a $100,000 investment, about 67 basis points more than a 5-year treasury, which is paying 4.43% at the current time. For a 6-year MYGA, you might be able to get 5.1% right now as well for a $100,000 investment. And for a 7-year MYGA, you might be able to get 5.15% for a $100,000 investment, about 58 basis points more than a 7-year treasury, which is paying 4.57% at the current time. And of course, if you were to invest more than $100,000, those rates would be even higher. For a $1 million investment, you might be able to earn 5.15% on a 5-year MYGA and a 6-year MYGA currently, and even 5.2% on a 7-year MYGA. As always, keep in mind that the MYGA rates in this table are illustrative, dependent on a number of factors, and subject to change at any time without prior notice, and that your personal rates and conditions are not fixed before you sign your annuity contract. And if you're willing to cast your net a bit wider, for this A-plus insurance carrier here, with $100,000, you may now be able to get to 5.3% with a 3-year MYGA, 5.55% with a 5-year MYGA, and even 5.65% with a 7-year MYGA, a full 108 basis points more than for a 7-year Treasury at 4.57%. Higher risk, higher return, right? But as I always say, everyone's financial journey is different, and an A-plus rated insurance company is still the second best credit rating that an insurance company can get from AM Best, as I mentioned earlier. Always stay under your state guarantee association's threshold. And don't forget that MYGAs are generally not liquid and don't pay regular interest. So, if any of these rates are interesting to you, or if you want to see what your MYGA, FIA, or other annuity options might look like whenever you're watching this video, email us at jennifer@diamondnestegg.com so that we can help you find the best annuity solution that's out there for you. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.